All right. Well, this part actually is the part I enjoy the most, and that's the whole idea of taxation of business profits. And so when we look at, um, when we go back, oh, yeah, this is a slide. When we go back here, we have covered this issue here of employment taxes. We have hit some of these others, but the others apply maybe a little bit different to a capital-intensive business than they will to a service company, but we've hit some of that. Now we're going to talk about the taxation of profits. Now, what I like to do is set up an example of what I mean by this idea of having tax on earnings that are retained in the company to grow and expand, okay? So we have a manufacturer, they manufacture tables. And so they put some money in, either borrow it or cash, and they buy some fixed assets. Now there's a lot of companies that are small enough that they're able to expense all this in the first year, or with bonus depreciation they get most of it, or maybe they're financing it, so they're paying for it at about the same rate as the depreciation. But bigger companies, the fixed asset write-off is going to be slower, typically, than the cash flow that you're paying out either to buy them in cash or to buy them on a loan, just generally speaking. So you can put money into fixed assets that you cannot currently expense, and how do you do that? Well, you either borrow or you retain earnings to do it. And if you borrow, you eventually have to retain earnings to pay off the borrowing, right? Then you go out and buy some raw materials. And say you buy whatever, there's probably not any wood in that, but whatever it is, whatever they put in there, the steel and all that, and you might have some other manufacturers making part of it and you're assembling and all that. So you buy your raw materials. Well, there's no tax deduction yet here. So here there's a partial one, maybe full compared to cash flow, but here definitely no tax deduction yet. You capitalize the cost in inventory, okay? Debit inventory, credit cash, or credit accounts payable. And then you go along and you are producing it, and so it's work in process, it's on the assembly line, it is not ready to be shipped, and you still don't have a deduction. You add all that. So you're paying your employees out in the plant, the electricity, the heat, and just a whole bunch of direct and indirect costs, no current tax deduction, no current book deduction. It just gets capitalized. But it's costing us money. Yes, we might be able to put some of it on credit, and your employees you're paying may be a week or two behind, but still, the cash flow is faster than the tax deduction. Then you have your finished goods inventory, and still no deduction, still capitalized. Then you go out and sell it, and say a lot of them are credit sales, so you sell it and you have an account receivable. You haven't received any cash, but you have to pick up the profit on that. At this point, you get to release the cost for that unit, that table, whatever, but you still are behind this tax 8-ball, this whole idea that you're paying tax on income that we measure and how we measure it for taxable income purposes and book purposes for the most part, accounting, generally accepted accounting principles. It's all historical cost, you capitalize cost, all that. And so we're putting out cash faster than we get deductions, and we are picking up income faster than we get cash. And so we have this phantom income, or whatever you want to call it. It's a bubble of income that we have to pay tax on, and we have no cash to represent that. And if a company continues to grow, presumably all these would get bigger, and so you continue to have that cash crunch. We have some companies that have grown so fast that it's really hard to finance their balance sheet, one of those items being taxes. Is they make an income on when you look at it from an accounting standpoint and a tax standpoint, they just aren't making, they just don't have the cash yet for it. Then if we pay down debt, if we have equity financing, great, but if we have debt, that takes retained earnings also. Now, if you keep the same level of debt, no, it doesn't, or you're increasing or something. But ultimately, there may be a certain level of debt you're going to keep, but usually over time, as you start to level off, mature state, you start paying down debt. Okay? And now, this is a manufacturer. And then over here, let's go back to the law firm, accounting firm. We buy fixed assets, except for really large firms. You can probably write that off under Section 179, bonus depreciation. You usually are writing it off actually faster than you pay for it if you finance some. If you finance none, well, about the same, because most people can expense under 179. I don't even know that we depreciate anything at Ray, and we're fairly, I'm not at Ray anymore, remember? I keep forgetting that. I bet you they can write everything off under 179, and that's a firm with almost 300 people. So then you come down here, and what's your raw materials? Well, that's your people, okay? So you have the producers, the people, you're paying them. And you get a deduction as you pay them. So cash flow and deductions are the same. The work in process, again, the time with people. In fact, we probably pay them ahead of when we pick up the income, right? We pay and then we have to bill and wait. So we're not picking up the income for a long time. We have economic income as services are rendered. We haven't billed it yet, but we have this expectation that we're going to bill it and we're going to collect it. So we have economic income. But we do not have cash yet, so we don't have to pick it up in the income. And that's mainly our people costs, and obviously all of our indirect costs are immediately deductible. We don't have to capitalize anything if we use cash basis. And then that's basically all the way through your finished product. You send them the will, you contract, whatever you do, you get them out of jail. Whatever you've done, you've completed it. All along, your deductions are coming in with your cash outlay, and your income is, actually your deductions could be ahead of your cash outlay. Not cash outlay, but income, economic income. But cash and deductions are pretty similar. Cash and income coming in are pretty similar, or the same. Accounts receivable, yes, we have them, but we're accrual basis for management purposes, and we show our accounts receivable, but for tax purposes, we're cash basis. So we don't have to pick that up in income. Debt, generally not a whole lot of debt. And if you have debt, it's usually attributable to the fixed assets. So in a way, that's helping this cash flow, taxable income thing match, all right? So the whole idea is that a service company, generally, after initial capital to have a cash in a checking account, they do not need to retain earnings to grow and expand that they have to pay tax on. Your accrual net worth in a growing professional firm will go up. The cash net worth, maybe because you have new partners coming in and all that, might come up, but it's more flat. You pay everything out. Everything's deductible, okay? So this is accrual, this is cash in a service company. In a manufacturing company, they would both take a line, something more like that, okay?